The hammer candlestick is essentially the same as the hanging man, but it must appear in a downtrend. This is a bullish one candle pattern that indicates a possible reversal. So the hammer, just like the hanging man, must have a small body, which can be black or white, and it must have a long lower shadow. The longer the lower shadow, the stronger the signal. So this pattern shows that sellers have taken the market down, but buyers have bought it back up and the market has finished near to where it started. So this indicates that momentum is slowing and a new uptrend may be about to take place. It also suggests the market may be hammering out a bottom. Here's an example on the chart of BD, shown by the green arrow. You can see the longer lower shadow where the market has fallen, but then the stock has been brought back up by the bulls. And you can see this set in motion a decent upward move. Here's another example in the chart of HPQ, Hewlett & Packard. So now we have the hammer candle pattern written down in code. We can run it through the AMI Broker simulator and see how it gets on. So in this instance, we will be buying the market on the close whenever there is a hammer and the market is in a downtrend, defined by a new 10-day low, because this is a bullish signal. And we're then going to close the trade after 1, 3, 5 or 10 days. So looking at this first table, you can see the results from buying the hammer and closing the trade after 1 full day, and you can see that this was a losing strategy overall. On our 21 markets, the signal produced an average loss of 0.1% with an average win rate of 46%. This was worse than the average one-day return for each market combined, shown by the benchmark. Across our 100 stocks, the signal did even worse with an average loss of 0.17% per trade. Again, this was lower than the benchmark daily return of 0.04%. Combining the hammer with a 3-day holding period lost money again in our 21 markets, but it produced an average profit of 0.09% per trade in stocks with a win rate of 52%. Buying the hammer with a 5-day holding period was a very similar story. We saw an average loss in futures and forex and an average profit of 0.09% per trade in stocks. With a 10-day holding period, the results are still not great. We saw an average loss of 0.01% in our 21 markets and an average gain of 0.19% in stocks. Overall, these results are not good. The hammer pattern does not seem to show any profitable edge in the markets we tested, and we underperformed the benchmark result in every test. In other words, we would be better off buying the market randomly than waiting for a hammer. Let's move on now to the inverted hammer. The morning star candlestick pattern is different from what we've seen so far because this is a free candle pattern. The morning star should appear in a downtrend and it indicates a potential bullish reversal. The first candle in a morning star should be a long black down candle. The second candle can be either black or white, and then the third candle should be a white strong up candle, which closes above the second candle and into or above the first candle. So this is the opposite of an evening star, and according to most sources, the signal is stronger if the second candle opens on a gap down. However, that rule makes this signal extremely rare, because you don't always get gaps like that, especially in liquid markets like forex. So here we have an example of a morning star pattern occurring in Chevron CVX. The pattern indicates quite a significant turnaround, and you can see that it set the stage for another upward rally. So after looking at the morning star pattern as it's described in most sources, I discovered that the pattern results in hardly any trading signals when you include the gap. So because of this, our formula doesn't include the gap, and I think it's much better this way because we want to have a large sample of trades to base our analysis on. So we've got the code written down, and in this instance O2 and C2 refer to the first candle in our free candle pattern. They've just been pushed back a couple of bars, and H1 refers to the second candle in the pattern. And our downtrend formula has been put back one candle because it would be wrong to see the third candle make a new 10-day low and then reverse above the second candle. Anyway, by putting this code into AmiBroker, we can identify morning stars and then run a simulation to see how buying this candle performs over time. So, buying a morning star on the close and exiting the trade 1 day later produced an average loss of 0.13% across our 21 markets. You can see that our best market was the 5-year note and our worst was sugar. In stocks, we recorded a loss of 0.04% per trade with a win rate of 48% across 4,297 trades. With a 3-day holding period, the Morningstar is still a losing pattern across our 21 markets, and it just about broke even in stocks. Results improved slightly with a 5-day holding period, where we recorded an average profit of 0.08% per trade in futures and forex markets, and 0.22% in stocks with a win rate of 52%. Both results here are better than the benchmark 5-day return. Finally, with a 10-day hold, the pattern saw an average gain of 0.13% across our 21 markets, but it lost money in stocks. So the Morningstar pattern has given us some mixed results. Overall, the pattern is not very consistent, and there's no evidence here that it's a profitable signal. Next, we'll look at the evening star. We spoke about how the doji is a signal of indecision, and the gravestone doji is actually a bearish type of doji candlestick that indicates a downside reversal. It should appear in an uptrend, which we have defined as the presence of a new 10-day high. It should have an extremely narrow body with long upper shadow and a very small or non-existent lower shadow. And the longer the upper shadow, the stronger the reversal signal should be. So this candle shows that the market has gone to new highs with a fair amount of strength, but then it's been brought back down by the sellers and it's closed right where it started. So this is an indication that the market is losing momentum, and therefore that the upward trend could reverse in the future. And here's a gravestone doji setup that we can see in silver. In this example, the gravestone doji did a poor job of spotting the reversal, which is so often the case with some of these patterns. So, using the formula we created, we can identify the gravestone doji on the chart and see how it performs as a short signal. In this first table, we see the results of shorting a gravestone doji pattern, as we defined it, on the close and then holding the trade for 1 whole day. As you can see, the pattern produced an average loss of 0.27% in our 21 markets with a win rate of 45%, and it produced an average loss of 0.18% in stocks, and both figures were much worse than the benchmark return. With a 3-day holding period, the pattern also did poorly, recording an average loss of 0.52% across our 21 markets, and it did just as bad with a 5-day holding period and a 10-day holding period. In fact, you can see that shorting a gravestone doji pattern is not a profitable pattern to look out for. The strategy has a low win rate and lost money on every test. Next, we'll look at the dragonfly doji. The bearish kicker pattern is a 2-candle pattern that is bearish. To be a bearish kicker, the first candle should be a long up candle or white Marubozu. The second candle needs to be a long down candle or black Marubozu, and it must open below the first candle open. As well, the second candle high must be lower than the previous candle's low, so just like the bullish kicker, a gap is formed. So this pattern is another rare one because of the gap, and also because the candles need to be strong up or down candles with only a small wick. It really shows a complete switch of momentum in the market from strongly bullish to strongly bearish, and that is the power of the pattern itself, as it suggests that bears have just completely overpowered the bulls and a new downtrend should be in force. And here's an example of a bearish kicker in Wells Fargo, shown by the red arrow. Notice the gap between the open of the second candle and the low of the first candle. So, as mentioned, the bearish kicker in its purest form doesn't occur very often. That's because of the gap and because the bearish kicker requires 2 opposing candles with very little shadow or wick. You can see that the pattern didn't occur for any of these 11 markets during our 16-year period, and we only recorded 152 bearish kicker signals in our stock universe during that time frame. Because of this, I don't think we can really draw too many conclusions from these results, which is a shame because we have some good results here, especially in stocks. For example, shorting a bearish kicker pattern and holding for 3 days produced an average profit of 0.4% in S&P 100 stocks with a win rate of 55%, and the pattern also did well with other holding periods. So there might be something to this pattern, and we might want to do a bit more work to see how significant these results are. Overall, this is one of the best short patterns that I've found. Next up, we'll look at the bullish engulfing pattern. The bearish abandoned baby is a 3-candle pattern that is bearish in an uptrend. The first candle should be a white up candle. The second candle should get up on the open and be a narrow range candle or doji. The third candle should gap down on the open and the gap should be larger than the first gap. This third candle should also be a black down candle. So this is a bearish signal. When it occurs, the theory is that the market should head lower, so we should short the market. The second candle tends to be key as it reveals the loss of momentum among the bulls. The idea is that this candle is completely abandoned, which should be a good sign of reversal. Here's an example of the pattern in Exxon. This was a clear setup, but you can see that in this example it did not predict a move lower. Shorting the bearish abandoned baby candlestick pattern and holding for 1 day produced an average loss of 0.2% per trade across 19 markets with a win rate of 46%. The results were a little bit better than break even for S&P 100 stocks. The numbers were modest with a 3-day holding period and slightly better than the benchmark results. With a 5-day holding period, we saw an average gain across both tests, as we did with a 10-day holding period. Shorting the bearish abandoned baby and holding for 10 days produced an average profit of 0.32% in futures and forex with a win rate of 50%. In stocks, we recorded an average profit of 0.13% per trade. This is an infrequent pattern and the results that we recorded are modest. Next up, we're going to look at the 3 white soldiers pattern. The 3 black crows pattern is a bearish 3-candle formation that must appear in an uptrend. This pattern consists of 3 or more candles with consecutive lower opens and closes. Each lower open should occur within the body of the previous candle. So this pattern shows a very visible change in momentum and a strong downward bias. Trend traders see this pattern as the establishing of a new downward trend. It's also noted that the pattern is stronger when the uptrend contains gappy price action. And here's an example of this pattern taking place in the dollar-yen currency pair. So the 3 black crows pattern is a bearish signal. So in our tests, we shorted the pattern on the close and then held it for 1, 3, 5 or 10 days. Running through these results, you can see that this pattern is not a particularly good one. The pattern does not do a good job of predicting further downward moves. We saw a couple of positive results, but on the whole, the average profit from this strategy is negative. For example, with a 10-day holding period, we saw an average loss of 0.5% in futures and an average loss of 0.18% in stocks per trade. In conclusion, it seems that selling into weakness is not a very successful strategy after all. In fact, you'd be better off doing the opposite. In other words, you'd be better off buying the market when you see the 3 black crows pattern. And if you look at the next tables of results, you can see what happens if you had done so. So here you can see that markets are more likely to go higher after 3 black crows than they are to go lower. I've reversed the formula so that we're buying the market instead of selling the market after the pattern. So with a 10-day holding period, buying the 3 black crows pattern instead of shorting produced an average gain of 0.5% across 20 markets with a win rate of 54% and an average gain of 0.18% in stocks. Next, we'll take a look at the bullish 3-line strike pattern. Like the dark cloud cover pattern, the tweezer top is another 2-candle reversal pattern that is bearish when it appears in an uptrend. I've found different interpretations for this pattern, but I think the one I'm going to show you now is the most common. So to be a tweezer top, the first candle should be a strong white up candle, where the body is more than 50% of the total range. The second candle high should be equal to the first candle high, and it should close below the previous candle's close. So this pattern signifies a switch in momentum from bulls to bears, where the market has been unable to break above the previous bar's high. Here you can see an example of the tweezer top pattern in gold. It's noticeable by the fact that the high is equal to the previous high, and on this occasion it did mark the beginning of a new downward move. The tweezer top pattern is a fairly rare pattern, but it did occur in all of our 21 markets at least once. However, as you can see as we scroll through the tables of results, the pattern did not pick out reversals all that well. Shorting the tweezer top pattern on the close and holding the trade for 3 days produced an average loss of 0.28% over our 21 markets, with an average win rate of only 39%. In stocks, we saw an average loss of 0.12% with a 50% win rate. The longer holding periods produced even poorer results. Shorting the tweezer top pattern and exiting the trade 10 days later produced an average loss of 0.29% in our 21 markets, and it produced an average loss of 0.17% in stocks. This is another candlestick pattern that has no edge according to our results. In the next lecture, we'll be looking at the tweezer bottom. As you would expect, the bearish engulfing pattern is the opposite of the bullish engulfing pattern. This is a 2-candle reversal pattern that signals a bearish reversal or a continuation of the downward trend. The first candle in a bearish engulfing pattern should be a small white up candle, and this can even be a thin doji candle. The second candle should open higher than the previous candle's close and then close lower than the previous candle's open. In other words, we have a small white candle which is then completely engulfed by a larger black candle. So this shows bears are really taking control of the market after a small initial up move. Here's a great example of the pattern in the euro-dollar currency pair. So now let's look at some results from shorting the market whenever this pattern occurs. So shorting the market on the close of a bearish engulfing pattern and then closing the trade 1 day later is not shown to be any better than random across our 21 markets or universe of S&P 100 stocks. Unfortunately, as you can see from these tables, the bearish engulfing pattern only gets worse with longer holding periods, and it didn't produce a single profitable run. Thus, we can make a clear conclusion about this pattern. The bearish engulfing pattern, as we've defined it here, occurs frequently, but it's not a winning pattern to look out for.